We are counting down to the October jobs report due out at 8:30 Eastern time today. It's expected to be distorted, perhaps, by some special factors like the recent strikes and hurricanes, but that has not seemed to impact some of the ADP numbers that we had, or at least we thought we had on Wednesday. I want to bring in Michelle Girard, head of U.S. coverage at NatWest, as well as the CEO of NatWest Markets. Good morning to you.
Good morning,
what are you expecting
Andrew.
on the jobs front, and how surprised were you by those strong numbers on Wednesday, rather?
Well, we were definitely surprised by the strength in those ADP numbers. Actually, the data this week were all surprising to the upside. We had good consumer confidence numbers as well. The claims numbers were lower than expected. So we're going into this report with seeming some upside momentum and certainly upside risk, given the upside surprises. As you said, there are going to be special factors, the strike and hurricanes that are, at risk of really depressing the number. It's really asymmetric, right? It feels like if the numbers are weak, we'll sort of attribute it to those, depressing one-off factors. If the numbers are strong, however, it's going to reaffirm that the economy continues to have good momentum and maybe picking up momentum.
How would you measure this economy if you were a professor?
Well, I think right now we're looking at an economy that is continuing to grow at a slightly above trend pace. We had great GDP numbers, great in a relative sense. We had, very solid GDP numbers this week from the third quarter. Consumer spending continues to hold in very well. But yet you've got inflation trending lower. It seems like I don't want to say a perfect world, but you've got, I'm sure, everything that the Fed would want to see, where the economy seems to be avoiding a recession. And yet you've got, you don't have the inflation pressures that you had a year ago. So for right now, I think things are looking healthy. Of course, everyone is focused on the election and the impact that could have in terms of the potential for changes in policies that might impact both the inflation and the growth story.
Well, let's talk about that. As you try to think about what the world looks like a week from now with these two different candidates, how do you see it in terms of both the inflation picture, what you think tariffs might do if former President Trump wins, if you think that there's going to be additional spending under a Harris world? Maybe you'll see additional spending on both. I don't know. Right.
I think we expect that you'll see probably additional spending on both sides. I think President Harris is certainly viewed in the markets as more of a status quo. We believe if she's victorious, that you'll have a divided government, and so in that sense, it may not be too different. Obviously, with the Trump presidency, and we believe if he is the winner, we'll see a united government. Most likely, the odds are a Republican sweep in that event, and so then you could see more significant changes in policy. And I think, not only on the fiscal spending side and certainly the extension of the tax cuts, but also on the inflation side. With the tariffs that have been talked about, or we've estimated what the impact of the 10% increase across the board on imports with 60% increase on China, that could push inflation, we think, close to 4%. So from our forecast of slightly under 2 at the end of 2025, if they were enacted sort of on day one, all else equal, obviously there's a lot of uncertainty. But to give you a sense, we would look for higher inflation that would, I think, certainly would impact our expectations for how much Fed easing we get next year.
Let me ask you separately. I don't know if you saw, but Elon Musk agreeing with this concept and effectively suggesting there would be at least a form of hardship for the economy for some period of time, especially during what was described as sort of these transition periods where if you were going to, really cut government, for example, or implement some of these tariffs or other things. So when you start to really think about what the economy could look like over the next 4 years under each candidate, what's your base case?
Well, again, it's so much will depend on what actually gets put through. There are conflicting factors, even in terms of President Trump policies. Obviously, the inflation and tariff impacts could be negative, less Fed easing. The regulatory relief that we've seen under President Trump could be a real positive for the economy, offsetting some of the impact of this transition period. So in the end, I think we're like everybody else, sort of waiting to see what actually gets implemented. We've seen before there's a lot of talk during the elections, but when push comes to shove, even with a united government, very narrow margins, it's just not clear exactly what will get through. Yep.
Michelle, if we're going to 140% of debt to GDP, isn't there pain coming at some point? Couldn't you make an argument that to do something smart, near term, in terms of what Elon Musk is going to try to do, and maybe you could be putting off something far worse that would happen 5 or 10 years from now, like even a depression.
Well, I mean, Joe, first of all, I think when we look at the fiscal picture, we could have said this even for the last 4 years. I mean, we've never seen the pullback in spending post-pandemic that you would have thought would put, obviously, the fiscal situation on a more sustainable path.
We're at $2 trillion. We made it down to $1.4 trillion after the pandemic. And there's no reason to be back at $2 trillion right now, and here we are. No reason whatsoever.
And you wonder at what point will the markets in the U.S. take notice? And you can see, obviously, in the U.K. the reaction of the markets, and with the release of the U.K. budget, which had more fiscal spending, and you're seeing yields rise. And at some point, you wonder if in the U.S. we'll see this. I mean, again, we're seeing that, I think, already with yields having risen, but more concern about the fiscal situation, even in an environment where the Fed is potentially cutting rates, yields stay high.
The cows may be coming home someday. There may be a day of reckoning. I don't see how there
has to be, but when, right?
It's just it has
exactly.
To be. If you do the numbers, we're at 150% by 2040 or 2050, and we've never even been where we are now at 100. What are we at? 108% right now. I mean,
we're talking about an economy that's doing pretty well, right? I mean, if we go into recession and we need more, so we're all thinking the same thing, but the markets are looking through a lot. Yep.
Right.